Well, good afternoon and welcome. I'm Merritt Jano, Dean of the School of International and Public Affairs, and it's my pleasure to welcome you here today. I feel enormously grateful and appreciative that John Williams is joining us today so early in his tenure as President and CEO of the New York Fed. We have a very deep commitment here at SEPA to the study of central banking and financial policy. Indeed, we have sent hundreds of our own graduates into the New York Fed and the Fed system, and indeed central banks and financial institutions around the world. So we are grateful to you, and it is indeed meaningful to us to have these ongoing special opportunities to hear from leaders around the world. I also feel, in looking at his resume, actually proud of our system, because we have someone in John Williams who has spent his whole professional life, thinking about the economy and the role of central banks in the financial system. As you know, he began his career as an economist at the Board of Governors of the Federal Reserve System. He served as a senior economist in the White House, Council of Economic Advisors. He's been a lecturer at Stanford University as a PhD in economics from Stanford, but also studied at the London School of Economics and at the University of California, Berkeley. And until recently, he was president of the Federal Reserve Bank of San Francisco. You know, in New York, we think that the New York Federal Reserve Bank is really very special. And of course, among the features that make it so is that the president serves as a permanent member of the Federal Open Markets Committee and vice chairman. So without further delay, please join me in thanking John Williams and welcoming him here today.
Thank you. Well, it's good afternoon, everyone. It's truly a pleasure for me to speak here at this workshop on monetary policy implementation, co-organized by the Columbia University School of International and Public Affairs and, of course, the Federal Reserve Bank of New York. So this is my first speech on the economy and monetary policy since I've taken this long journey from the West Coast to the East Coast. And it's great to be here, especially now that summer is finally coming to an end and winter hasn't yet hit. One of the things I was promised coming here was that there were actually 2 seasons of the year that were pleasant in terms of weather. I am still waiting for one of those, but I'm told that maybe we're about on the cusp of entering fall. Now, this workshop covers very important and timely issues, including reserve reductions, money markets, and future frameworks, a topic I'll touch on in my remarks. And of course, it represents an important continuation of the Fed's tradition of a robust dialogue with the financial and academic communities as we seek to gain a better understanding of the impact of our policies, our decisions, and the changing financial market conditions and structures. So in my remarks today, I will focus on monetary policy, highlighting the evolution of the Federal Reserve's policy actions and communications as we've exited from the extraordinary stimulus that followed the crisis and the recession. Now, the good news is that 10 years after the financial crisis, the U.S. economy is doing very well overall. From the perspective of the Fed's dual mandates of maximum employment and price stability, quite honestly, this is about as good as it gets. As a result, the Fed has naturally been moving gradually towards more normal monetary policy. And that brings me to the topic or the theme of my remarks today. So what does normal monetary policy look like? For a lot of people, they haven't seen normal policy in a decade, and so that's what I'll talk about. But before I go even one word further into my remarks, I should note that what I have to say represents my own views and does not necessarily represent any views represent the views of the FOMC or anyone else in the Federal Reserve System. So my take on the economy is well summarized by the most recent FOMC statement, in which we use variations on the word strong 5 times in only 4 short paragraphs. So in our statement, we refer to strong labor market conditions, strong job gains, a strong rate of growth in economic activity, household spending, and business fixed investment. So for some of you who read these FOMC statements, you might think it's about time for us to buy a thesaurus, but honestly, at least we can't be accused of ambiguity. The Fed has attained its dual mandate objectives about as well as it ever has. Most indicators of the labor market show it to be very strong, including the unemployment rate, which is now below 4%. And the inflation rate is very near, now with the latest data, is right at our 2% longer run goal. And with fiscal stimulus and still favorable financial conditions providing strong tailwinds to the economy, the outlook is for more of the same. So let me put some hard numbers to that. I expect real GDP to grow 3% this year and about 2.5% in 2019. And this above-trend pace of growth should lead to solid job gains and further declines in the unemployment rate. I expect the unemployment rate to fall slightly below 3.5% next year, and that will be the lowest unemployment rate in the U.S. in nearly 50 years. And in keeping with the strong economy, I expect inflation to pick up or edge up a little bit above 2%, but don't see any signs of greater inflationary pressures on the horizon. And I continue to expect that further gradual increases in interest rates will best foster a sustained economic expansion and achievement of our dual mandate goals. Now, I should hasten to add that not everyone has shared equally in this otherwise very strong economy. The unevenness of the recovery is evident in my travels around the 2nd District here in New York, where, for example, the recovery in upstate New York continues to lag the rest of the nation. So while the national economy is in quite good shape, longer-run economic challenges have meant that not all Americans have shared or benefited from these improvements in the overall economy. And beyond supporting strong overall growth, monetary policy has limited reach into these issues, which are really best addressed through investments in education, workforce development, and economic development. So in thinking about the outlook for monetary policy ahead, it's useful to roll back time a bit and remember how we got where we are today. The financial crisis and the Great Recession led the FOMC to lower the federal funds target to close to zero, and it kept it there for 7 years. And this lengthy spell at near zero reflected the long shadow of the crisis, evident from the subdued growth rate and low inflation rate, and the need for the economy to convalesce after enormous trauma. With the unemployment rate still very high and inflation low, the Federal Reserve embarked on a long journey through terra incognita of unconventional monetary policy actions, including asset purchases and forward guidance on the future path of interest rates. And in that regard, we were not alone. Many other central banks conducted those policies, in fact, even went further down that road of unconventional policies during this period. In part, due to the Fed's actions, the U.S. economy gradually recovered, and as a result, the FOMC has been slowly but surely moving monetary policy back to normal. And this process, I think, can be best thought of in terms of 3 stages. So the first stage of policy normalization focused on the liftoff of the funds rate from near zero, which occurred finally in December of 2015. But well before we did that, before that happened, the FOMC went to great effort to communicate our thinking to the public and to better prepare the public for this change in policy. Importantly, we also made extensive preparations to ensure that not only were we ready, but also able to raise interest rates as needed in the context of the very large Fed balance sheet and quantity of bank reserves. And consistent with the Fed's aim to be as transparent as possible, we published our plans on how we would use interest rates paid on bank reserves and on overnight reverse repo agreements to keep the federal funds rate within the target range. At the time, in light of the shallow recovery and low inflation, the FOMC was very focused on balancing the risk of a premature removal of accommodation against concerns that excesses could build up in the economy. In the end, liftoff went off without a hitch, and the approach developed back then has served us extremely well in controlling the federal funds rate. It's proven to be a very flexible approach as market conditions have evolved. And I'm going to come back to that point later. So that was the first stage of normalization. And we then entered the second stage of normalization following liftoff, and that consisted of 2 processes. The first was raising the federal funds rate closer and closer to more normal levels, and that reflected the ongoing improvement in the economy. And the second process was the gradually reducing the Fed's balance sheet as we worked to unwind the asset purchase programs that were put in place after the crisis. So let me talk a little bit about interest rate normalization. Since liftoff, we've raised interest rates as the economy has moved towards maximum employment and our 2% longer run goal. And we continue this process with our most recent rate increase this week. Throughout, we've repeatedly stressed that we foresaw this as a process of gradual normalization, reflecting the balancing of risks to reaching our goals. In particular, downside risks to the achievement of our employment and inflation goals and goals amid very low interest rates were compelling arguments for what was a very cautious and a relatively predictable approach to policy. And that approach proved its worth. The economy continued to expand at a healthy pace even as we raised interest rates numerous times. I'll turn briefly now to the normalization of the balance sheet. This is actually a story that's been described by one of my colleagues as like watching paint dry, so I'll go very quickly through this. We began the process about a year ago in the now standard Fed practice of communicate. We published detailed plans well in advance on how we would gradually and predictably reduce the balance sheet. And as with liftoff, this process proceeded smoothly, without market volatility or disruption, and that's the way we wanted it. This brings me now to the third stage, and I think the kind of more interesting part of what's happening in monetary policy, and that is normal monetary policy. So as interest rates have moved well away from zero, and the balance sheet has started to shrink, a natural question arises. So what does normal monetary policy look like today? So as before, I'm going to start with the interest rates, and I'll come back to the balance sheet. So for those of you who follow the Fed very closely, you've noticed that the FOMC has been slimming down the statements of late and using less forward guidance about the future path of policy. And that, in this vein, the FOMC this week removed language from the statement indicating that monetary policy remains accommodative. So let me make clear, these more concise statements do not signify a shift in our monetary policy approach. Instead, they represent the natural evolution of the language describing the factors influencing our policy decisions in the context of the strength of the economic outlook and inflation being nearer at our 2% longer run goal. So these changes in how we communicate our policy views are a sign that we're nearing the end of the second stage of normalization process, and we're inching closer to conducting what I think of as more normal monetary policy. Now, again, it's been a long time since monetary policy has been normal, so it's worth talking a little bit more about what normal might look like. At its most basic level, policy making is going to stay the same. The path of interest rates will continue to be guided strategically by our dual mandate objectives and shaped tactically by the data and the implications for the economic outlook, and will continue to be as transparent about our thinking about the economy and monetary policy as possible. But changing circumstances also call for some changes in how the FOMC communicates its policy views. Now that interest rates are well away from zero and the economy is humming along, the case for this strong forward guidance about future policy actions is becoming less compelling. For one, the future definition of policy is no longer as clear as it was during the past few years. Back when interest rates were extremely low, it was obvious which direction interest rates were headed, and that was upward towards more normal levels. And our forward guidance regularly reinforced that point. At some point in the future, it will no longer be as clear whether interest rates need to go up or down or stay the same. And so explicit forward guidance about the future path of policy will no longer be appropriate. In addition, as we moved away from near zero interest rates, it makes sense to shift away from a focus on normalizing the stance of monetary policy, this policy normalization language we've talked a lot about, especially relative to this some benchmark neutral interest rate, often referred to as R star. Now, I've spent a good deal of my career studying and talking about R star, and I do find that to be a very useful concept for thinking about the long-run behavior of the economy. Having said that, I have to admit that at times R-star has actually gotten too much attention in commentary about Fed policy. Back when interest rates were well below neutral, R-star appropriately acted as a pole star for navigation. But as we've gotten closer and closer to neutral, to the range of estimates of neutral, what appeared to be this bright star that was guiding us has become clear that it's more of a fuzzy blur, reflecting the inherent uncertainty in measuring R-star. More than that, R-star is just one factor affecting our decisions, alongside the other concerns around the economic and labor market conditions, around wage and price inflation, global developments, financial conditions, risks to the outlook, and I could go on, but I think you get the point. Returning to the balance sheet, the question of what exactly the new normal will look like is still being analyzed and discussed at the Fed. We have indicated that we plan to shrink the balance sheet to the smallest size consistent with an effective and efficient conduct of monetary policy. And in the long run, the asset side of the balance sheet will consist primarily of Treasury securities. So that's our strategy. But the execution of that strategy is going to depend on the operating framework for monetary policy, among other factors. And here, in my view, the Fed basically has two choices. One is we could return to a system similar in spirit to that used before the financial crisis, in which the supply of reserves in the banking system was kept relatively scarce, and the interest rate was set by adjusting reserves on a frequent basis through open market operations. Alternatively, we could continue with the system that we've been using since the crisis, in which bank reserves are abundant, and the federal funds rate target is achieved through adjustments to administered rates. Now, as I said earlier, this approach that we've been using for the past several years is working very well at controlling interest rates, and it's been proven to be very easy to communicate, and has been proven to be adaptable to changing circumstances. Now, the Fed will be looking closely at these options in the coming months, and we will subsequently make a decision about the future operating framework. And as is our standard practice, which I've emphasized over and over again, we're sure to communicate our thinking and decisions on this issue as soon and as thoroughly as practicable. So monetary policy has perhaps never been more challenging than it was during the past decade following the financial crisis. But as we move towards more normal monetary policy, we shouldn't rest easy and think we won't confront our own set of future challenges. The most important one right now is sustaining this very long and healthy economic expansion without allowing risks to grow that ultimately undermine economic prosperity. Whatever the future may bring, I'll be guided by our dual mandate, a heavy dependence on data, and a steadfast commitment to transparency. Thank you.
Start us off and then open it up. Could you say a little bit more about how you think about the risks that are in the system today?
Risk in the economy and financial, sure.
Yeah.
So, often monetary policy is described as really about risk management, about thinking about our dual mandated goals, which are maximum employment and price stability, and thinking about all the uncertainties there are, both in the U.S. economy, in the global economy, and the financial system, and in making policy decisions that try to best balance those risks so wherever the future may go, we're well positioned for that. When I think about the risks of the economy today, I actually think I'm going to highlight something I said at the beginning. The economic outlook right now is, am I on? Am I good? Okay. It's actually really strong. I made the kind of joke about we say strong, 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 but I would reiterate that. So I think that when we talk about the risks of the outlook, it's in the context of a very good underlying outlook. When I would say there's a couple areas that I'm probably more focused on. One is in the international arena. Obviously, there's concerns around emerging markets and how, given developments in a few countries where they're under quite a bit of stress, whether there could be further spreading of kind of contagion to other countries around the globe, as next few years progress. So watching, making sure that the global economy is strong at the same time that our economy continues to expand. I think there are other issues out there that I worry about in terms of risks. One of them is the issue of fiscal policy right now is providing quite a strong tailwind, pushing the economy to grow faster for the next couple of years, but quite honestly, there's some uncertainty about how fiscal policy will look in a two or 3 years in the future when fiscal policy could actually switch to be more of a contractionary force for growth. And so, again, just have to weigh those kind of issues in terms of forming our economic outlook and be well positioned that depending on how the circumstances change, we can adjust policy. And I'll have to say the last one, which is the one that's probably the first one in everybody's list, is trade policy. I'm sure you were going to ask that if I didn't say something. So that's obviously a topic that we hear from all of our business contacts when you talk to people who are farmers or run businesses or people in, obviously in financial markets. This issue of how will these trade negotiations develop, how will they affect the U.S. economic outlook, how they affect inflation and the economy in terms of jobs, is something that we've tracked very carefully and have to obviously take as something that we don't control, but obviously we need to understand well and be ready, well positioned to achieve our goals of maximum employment and price stability.
Thank you very much. Let's open it up for questions. Please, not speeches, but sir. If you could identify yourself then.
Francesco Papadia from Bruegel Institute in Brussels. You just now referred to fiscal, and if I understood you correctly, your preoccupation on fiscal is maybe in 2 years' time, fiscal could become restrictive when the economy is not doing as well as one could hope. But don't you have now a worry that you are seeing this quite unprecedented experiment of doing a lot of fiscal easing when you are at more than full employment? I mean, this is quite exceptionally pro-cyclical, and doesn't that enter into your worries?
Well, I mean, obviously, when you think about it, so the question is really about, isn't the fact that fiscal policy is providing a lot of stimulus to the economy today, which is true, I agree with the premise, isn't that you're creating a kind of unusual circumstances well into the economic recovery and expansion. Now we're getting an extra dose of fiscal stimulus. That is unusual relative to past cycles. It's not unprecedented. You could think of the late 1960s as another example of that. But again, I would just answer that question the same way I would answer any question about factors, whether fiscal policy, trade policy, or global developments, that monetary policy is, we have a limited set of tools. We have obviously interest rates that we can use, and we use the tools that we have to best achieve our goals given whatever economic environment we're working in. So right now we're getting quite a boost to the economy over the next couple of years. Obviously that is part of the outlook that my colleagues and I kind of we factor that into our forecast and our analysis of where the economy is going. In terms of being unprecedented or unusual, I think that isn't worrying me in the near term as much as the possibility that fiscal policy might, kind of turn abruptly or something else. I will tell you that in terms of the economic outlook, I say things like this is about as good as it gets. I mean, the good news here is, we're not only is growth around 3% this year and expected to be above trend next year, is that there's really no signs of inflationary pressures. Wages are growing in a way, I think, consistent with a sustainable path. So, even though we're getting this extra dose of fiscal stimulus at this point, it's not, at least in my view, creating significant imbalances of the economy, whether in the financial system or inflation, at least so far.
Thank you. Professor Ito. Please. I think there's a mic coming to you.
So you touched on this international spillover of the U.S. Monetary policy. Not only emerging market economies, but I think advanced economies, there will be exchange rate implications because ECB is still expanding balance sheet, BOJ is still expanding balance sheet. So obviously the decision by the United States has exchange rate implications. And the exchange rate, of course, has a spill back into the U.S. economies. How much do you pay attention or put the variables in the model to see those spillback or global factors coming back to the U.S. from your decision to that's I'm interested in knowing it.
Right. Well, I mean, this question is really about how do we, in thinking about monetary policy decisions, obviously we affect financial conditions and importantly affect the exchange rate and other aspects of the financial variables around the global economy, and that feeds back into the U.S. economy. Obviously, my answer is the answer to the question is what do all those economists at the Fed do? One of the things they do is they, do a lot of analysis around those kind of things, and we have obviously, as you know, global models, multi-country models, and trying to take into effect that all of these things are interconnected. I'm a macroeconomist. To me, the mantra of a macroeconomist is that everything depends on everything else, and you just have to wrap your head around that. And once you do, then you can go forward. So clearly, understanding those channels, understanding how our policy actions affect international financial conditions, global conditions is a big part of what we talk about. I do think from a strategic point of view, we do have with most of our advanced economy trading partners, they have obviously flexible exchange rate regime. The flexible exchange rate is actually, I do believe, very effective shock absorber in terms of how the U.S. economy is growing faster now while some of the other economies aren't, and the exchange rate adjustments that come out of that are part of our kind of very good global economic financial system. I think our job, as any central bank's job in thinking about these issues, is we obviously focus on our domestic objectives of price stability and employment, but the reason I mentioned communication so much in my comments and the reason we spend so much time on communication and engagement with our colleagues around the world is that not only do we need to get our policy appropriate for the U.S. economy's outlook, but we also know that what the decisions we make affects the global economy, affects countries around the world. And so the better we can make our actions predictable, coherent, well understood, data dependent in an appropriate way, I think that actually helps lessen undesirable or unintended disruption or volatility in markets. Knock on wood, so far the balance sheet normalization, the policy normalization, I think has gone relatively smoothly, and I'll give our former chair and our current chair a lot of credit for the leadership around emphasizing the communication around our policy and not just the decisions we make, and emphasizing the fact that we recognize that the Federal Reserve decisions obviously have global factors, and that we need to make sure we understand those fully.
Thank you. Ito-sensei, I think there was a question behind you. Gentleman behind you. Thank you.
I don't think the mic works.
Brian Sack-Shaw. I have the mic now. So in your remarks, you noted that the operating framework has yet to be decided, but you also noted the principle that the balance sheet should be as small as possible, consistent with an efficient policy framework. So that statement conveys that there's a cost to having a larger balance sheet. And exactly how far in you will choose to move will depend on what that cost is and how big it is relative to the benefits of a large balance sheet. So I guess I wanted to ask, what do you see as the primary cost of the Fed maintaining a larger balance sheet? I mean, is it a political argument, or is it an economic argument, or what?
So, I mean, as the question basically is, the balance sheet, the size of the balance sheet is something that we determine in terms, especially of bank reserves, as a policy decision. And so, before the crisis, we ran, a system with very limited reserves. Today, we have, we're still running with very large set of reserves because the balance sheet, the asset side of the balance sheet is so large. So the question is, what's the right size of the balance sheet, and what are the cost benefits of that? And I do think that there are benefits of a more significant size of reserves in the system relative to the scarce reserve system. I'll just take that one and come back to yours question, Brian. But so I think there are advantages. Reserves are a pretty unique asset in the banking system. They're completely safe. They're overnight. They're very liquid. They're very secure kind of short-term instrument that provides liquidity to the financial system. So I think that there are a lot of benefits to having ample reserves in the system. And so I think there are benefits on that side. I think there on the cost side, I think some of the issues really are related to what's the appropriate, the phrase that is often used as footprint of the central bank in terms of how big of a role do we play in the financial system. So if we're holding $2 trillion of reserves, or there's $2 trillion of reserves in the system, that obviously has an effect on the financial system and how it operates, and the Fed is basically playing a bigger role in that. I think there are some, honestly, political concerns around, again, the role of the Federal Reserve in the financial system, which might not be simply about the economics, but about how big a role the Fed should be out there. Now, my own personal view is that on this issue is that, again, there are advantages to having ample reserves. There may be some cost to having too large of reserves in the system. I think that the right way to think about this is what we really also care about fundamentally is making sure that we can conduct monetary policy effectively. And so when you think about these different choices or exactly the amount of reserves, to my mind, getting that number exactly right is not as important as making sure that we have a system that in pretty much any circumstance, that when the FOMC, I always do my Star Trek analogy because that's who I am. So when the captain says engage and says move interest rates in this way, that the chief engineer has got the engines moving and moving the interest rates where they want to be. So that's really, I would say, to me, the job number 1, 2, and 3 around this, and that's why I emphasize that the system we use today, I think, really works incredibly well. It's going to have to. We've been making some small adjustments to it in order to make sure it works well, but that's really what I'm most focused on. I think that this other issue of exactly what's the amount of efficient reserves, I think, is a little bit uncertain, but maybe not as important as getting this first thing right.
Thank you. I think in the back, sir had his hand up early. Yes, you, in the back.
Mike?
Hi, yes, Mike Woodford from the Economics Department. So you talked about where we're headed as a return to normal monetary policy, as if once the lingering effects of the crisis are over, it might be appropriate to conduct policy pretty much the way we did before the crisis. But I think one way in which we can't go back is that now we're aware of what happened and the fact that things can go very wrong in the financial sector. And I'm wondering to what extent you think going forward, the Fed has to think more proactively about whether monetary policy has any effect on the likelihood of repeating an event of that kind, and if so, if that requires a change in any important way in the policy framework.
Right, and Mike and I both knew that this was could be a problem beforehand. So the zero lower bound kind of issues. So I did want to separate out the two kind of issues. So let me clarify what, in the limited amount of time I wanted, in my remarks, I kind of wanted to just focus on thinking about the policy decisions we're making, policy decisions we're likely to make over the next few years. So there is this deeper question, this bigger, longer run framework question that a number of my colleagues and I have raised, and I think the way you're raising right now, regarding the lessons of the crisis, the zero lower bound, the effectiveness of QE and other unconventional policies, and how well prepared are we, and quite honestly other central banks, to respond effectively and achieve our goals the next time there's a recession or downturn of some kind. Now, the Federal Reserve, we have been obviously discussing those issues, thinking hard about those issues, and continue to do that. And my expectation is that we will, have a, serious ongoing the process of considering how, what are the tools how effective the tools are, what are the tools, how effective are our tools, and really how can we make sure that the policy framework that we're using is most effective achieving our goals in whatever circumstances we run into. Now, again, speaking for myself, I think the Bank of Canada provides a very nice example of a way to do that every 5 years, typically. Every 5 years, they have a pretty thorough review of their policy framework, the inflation objective, how their approach to that, and does that best achieve the goals in this context. To my mind, for us, we don't have that kind of automatic 5-year review process. It would be nice to be able to create some kind of process that has a similar recurring flavor, not an ad hoc kind of process, but something that every so many years we come together, think about that. No surprise here, since I'm kind of known to have a view of a very low neutral interest rate, a low R star. I am very concerned about the amount of basically scope for action of cutting interest rates whenever there is a future recession. I do believe our tools are very powerful. I do believe that the Fed was very effective in using unconventional policies. But given the limited ability to lower interest rates, in my view, whenever a next recession might come, I do think we should be, it's just a matter of best practice, reviewing our approach to policy, how to best achieve our dual mandate goals, and including a broad spectrum of views and thinking through those issues. As you probably know, I've talked a bit about different alternatives, price level targeting. Obviously, Ben Bernanke's talked about proposals. Others have talked about proposals. I think that's healthy to get that conversation maybe started, but I think we need to have a much fuller, in-depth look at this. But really the point of all this is not, do you want to do inflation targeting or price level targeting or something like that? It's really the question is, how do we have the highest amount of confidence, whether the US or other central banks, that we can achieve our mandated goals whenever that next downturn happens.
Thank you. Over here, sir. Yes. Mike's coming to you.
Krishna Guha with
This is the problem with these battery-powered mics. I mean, they just go to who? Go ahead, Krishna.
So, John, I was struck that you, in your remarks, you talked about how you see unemployment going a little below 3.5%, I think it was next year. So I just wanted to ask, how much weight do you, in your own thinking, put on the gap between that unemployment rate path and estimates of NAIRU over the coming years? Quite a wide gap, about 1 percentage point under some of the more conventional estimations of NAIRU, in a context where, as you mentioned, we don't see, at this moment at least, too much inflation, and indeed inflation expectations remain somewhat subdued. Do you think that ultimately it will be necessary to push unemployment back up? And do you agree that it will be necessary to move to a restrictive posture of policy to do that, to achieve medium-term stabilization?
So obviously there's a great set of questions on kind of the core kind of issues around understanding where the economy is relative to full employment. I think, in a way, this problem is a little bit simpler than it might be it appears with these, ideas of long-run estimates of the natural rate of unemployment comparing the path. I think if I looked at the median path, it gets around to 3.5, and I think the median unemployment rate might be 4.5, like you're pointing out. So the way I think, obviously as a macroeconomist, I have these concepts in my mind, but I also just would reiterate something that I think is really important, is these estimates of the natural rate of unemployment are very uncertain. There's been a lot of great research over the decades highlighting the uncertainty around those estimates and the fact that they may, natural rate of unemployment or NAIRU may be changing over time. So this is kind of what I think of as data dependence, right? We have a dual mandate goal. It's maximum employment, which is, basically translated, through arithmetic is let's have the lowest unemployment we can have that's consistent with stable and low inflation, which we've decided the 2% inflation is a desirable goal. So it's really about let's find this perfect combination of sustainable and low inflation and sustainable growth and consistent with maximum employment. So, we can use these structures or concepts like NAIRU and R star and Y star and G star and every star in the world, which in order to kind of frame issues and maybe contextualize these issues. But I think in the practical world of policymaking, we have to be humble enough to know that really we're going to be driven by the data. If this economy, let me just put it bluntly, if this economy can run an unemployment rate of 3.5%, or just use that number, and have inflation be stable and be in good macroeconomic balance, that's terrific news. I would love that to be true. And over the next year, we're going to get more evidence. Is an economy with a 3.5% unemployment, does it show signs of that it's out of balance? Do we see inflation pressures rising? Or do we see other signs that the economy is getting out of balance? So you can start with this like point estimate of 4.5 natural rate or whatever your own view is. But I think really the data we're going to accumulate over the next few years is going to be very informative, on a number of issues. Really, like what is maximum employment? What's the labor force? How is labor force participation going to react to what will be the longest expansion in U.S. history, right? And the lowest unemployment rate in 50 years. So I think we're going to learn a lot along this way. I will say, a baseline view could easily be a one view of this is this economy is going to need to slow somewhat to be at a more sustainable pace, and that we can't have this economy continuously growing at very high rates. Another view is actually it can be supported by that. Luckily, we've got, again, the hundreds of economists who are working hard, many of them graduates of this institution, who are helping us think through these things, analyzing this. What we really need to be driven by is by the data, kind of the analysis it tells us, it informs us, and as Chairman Powell said in his Jackson Hole speech, not to be overly wedded to some particular estimates of these variables.
Thank you.
Wow.
Gentleman over here. And then I'd love to get one
Is it?
student. Do we have a student? Okay.
This
All
is
right.
actually not a Fed reunion, is it?
No. Okay.
I'm Sheriar Antia. I'm with Nippon Life Global Investors. So I'd like to touch on rate policy next year. Specifically, you were talking about maintaining this sort of happy path of strong employment, benign inflation. You and your colleagues have spoken about a number of sort of guidelines and factors that you'll be weighing and considering. You mentioned R star earlier, the neutral rate. Another factor that folks are looking at is yield curve inversion. So I know that you have done some, well, the San Francisco Fed certainly has done an awful lot of work around that, and I'd like to hear your current thoughts on that. And also, are there any other factors that folks on the committee consider when they're contemplating this balance?
Right. So this is really kind of getting at this issue of which is on a lot of people's minds, is the Fed somehow tightening policy perhaps more than is apparent, and the inverted yield curve, meaning the short-term interest rates are actually higher than long-term interest rates, which historically has been a sign of or a predictor of an economic slowdown, so how does that fit into that? Right now, short rates are well below long rates, so we don't have anything near a inverted yield curve. I always have to say that, because if you read the news reports and stories, you sometimes think that the yield curve is either about to be inverted or not, and at least on a T-bill rate versus a 10-year Treasury, we're nowhere near there. I think we're just in the late cycle. We're in a long expansion in the fact that we're seeing some flattening of the yield curve is not telling us too much more than that. So the way I view it is financial conditions we look at tons of financial conditions. I say we, I'm not going to speak for my colleagues, but generally all of us are looking at conditions in the financial sector, looking at long-term yields, looking at stock prices and spreads and a lot of different financial conditions. And I think they do tell us things. They kind of give us, for example, the yield curve. They're telling us what market participants kind of see where the risks are down the road, which I would read as my interpretation is telling us that interest rates in the future, 5 to 10 years from now, are going to be relatively low in expectation compared to history. The inflation risks seem to be considered to be low in markets. So I think we're learning that there's a relatively low interest rate, low inflation environment, and that's what we're hearing from the markets. We're obviously seeing from the stock market a reflection of very strong earnings, some tax changes and things like that. So to my mind, I don't want to fixate on the yield curve or on one particular measure of R minus R star, although my measures of R star you should fixate on a little bit. No, just kidding. But I think that the point is that we're getting lots of information from different sources, and really, if I would say one of the many amazing things about working at the New York Fed for people is that we have all this data, we have these amazingly smart people, and we're thinking about these issues all the time and applying them to the world. On the last thing on the yield curve, I know we're running low on time. I think there are two pieces of information in the inverted yield curve that are tricky at this juncture to analyze. One is we know in history the yield curve in the U.S. has been a pretty strong predictor, an inverted yield curve of a recession. At the same time, there are other models of yield curves that are very close to the standard model, which maybe adjusts for a time varying term premium. Or instead of looking at 10-year short rate, they look at interest rate expectations 2 years out versus today. And these are all should be telling you basically the same thing. But today, in today's world, which I think is still pretty unusual, where the Fed and Japan and Bank of Japan and ECB and other countries are still very active in unconventional policy stimulus, I think that the signals we're getting from one model or another may be somewhat distorted. So I tend to look at several of these models at once and do a little bit of Bayesian model averaging, and that means one model is telling me possibility of recession may be going up a bit, others are saying not, and just paying attention to all the models, but maybe not getting too much signal from one model that's telling you one thing while others aren't. And I think that's just part of constantly trying to filter the signal out of different indicators.
Well, thank you so much. I know you have a hard stop at 5:30, and if we're going to have you back on campus, we'll respect that today. So thank you so much for being with us. Great to have you in New York. Please join me in thanking John Williams.